Hello everyone, this is Dr. Madhulika Gupta, and today we are going to conduct a session on capital structure, right? It is a part of financial management. So let's understand what is capital structure. It is basically a combination of debt and equity used by a company to finance its operations. So what are debts? Debts are in the form of bonds or loans, and equity may be in the form of common stock, preferred stock, and retained earnings, right? So what is optimal debt equity ratio? To decide that, we'll have to consider business risk and financial risk. So let's understand what is business risk first. What are the factors of business risk? Demand variability, sales price variability, input cost variability, ability to develop new products, foreign exchange exposure, and operating leverage, of course, that is fixed versus variable cost. So there are business risk normal involved. So what is financial risk? It is additional risk placed on the common stockholders, that is equity shareholders, as a result of decision to finance with debt. Now, what is that? Let's understand. So what is the relationship between business risk and financial risk? We'll understand with the help of an example. If the same firm is now capitalized with 50% debt and 50% equity, that is, for example, 5 people investing in debt and 5 people investing in equity. So the 5 who put up the equity will have to bear all the business risk. So the common stock will be twice as risky it would have been at the firm been all equity, right? So the equity shareholders have to bear all the risk. So that is the main reason behind it. So financial leverage concentrates the firm's business risk on the shareholders because debt holders who receive fixed interest payments bear none of the business risk, right? Their leverage increases shareholders' risk, and leverage also increases the returns on equity, right? For example, if there is risk, there is also return, because to compensate for the higher risk. Because if there is profit, in some year, they don't have to share their profits with debenture holders, right? They just have to pay them the interest, that is fixed rate of interest, and the remaining profit, if it is excess profit, it's completely of equity shareholders. So that's a benefit. This compensation for taking high risk, right? So what are the advantages of debt for a company? So interest is tax deductible. Whatever interest they are paying on debenture to debenture holders are tax deductible, right? So debt holder limited to a fixed return. So stockholders do not have to share profits, as I told you, and debt holders do not have any voting rights. What are disadvantages? Unlike equity, debt must be at some point of time repaid. Interest is fixed cost, right, which raises the company's break-even point. That means the higher interest cost during difficult financial periods can increase the risk of insolvency, because you have to pay interest on loans taken or debenture holders irrespective of profit or loss, right? So that's a risk behind it, right? So what are the factors influencing capital structure? Business risk, capital tax exposure, financial flexibility, management style, growth rate, market condition, cost of fixed assets, size of business organization, nature of business organization, and of course the elasticity of capital structure, the combination of debt and equity. So now let's understand what is optimal capital structure that we'll be doing numericals on. So the optimal capital structure of a firm is the best mix of debt and equity financing that maximizes what? The company's market value while minimizing its cost of capital, of course. What is cost of capital? That interest we pay on debentures and dividend we pay to the equity holders are cost of capital. However, too much debt increases financial risk to shareholders and the risk and the return on equity that they require. Thus, companies have to find the optimal point at which marginal benefits of debts equals to marginal cost, right? So we'll be doing numericals to find out the optimum capital, that's the best capital combination for the company. You'll be advising them, right? So let's look for the first example. You'll understand in a more better way. So the example says, a limited company is considering different methods of finance its investment proposal. It is estimated that initially rupees 40 lakhs will be needed, and 2 alternative methods are available for raising the funds. What are 2 available options given to us? To raise rupees 20 lakhs by sale of equity of rupees 100 each, and balance 20 lakhs by 18% term loan. The second option to us is to raise the entire amount by sale of equity of rupees 100 each. That means entire 40 lakhs by 100 rupees each share. So the existing capital structure of the company is also given to us. irrespective of the above new that were investment proposal given to us. What is the existing capital structure? 50,000 equity shares of rupees 100 each and 17% term loan of 20 lakhs. This is existing. EBIT is given to us 15 lakhs. We have to advise the company on the basis of EPS in each alternative. Income tax rate is given 50%. Now let's see. Let's move forward to a solution. So we've got 3 columns: particulars, alternative 1 given to us, alternative 2 given to us. We'll check out in both the alternatives. We'll calculate EPS and will then give the decision which alternative is best for the company, that is which capital structure is best. So first of all, we'll start with EBIT. So it is 15 lakhs EBIT given to us. We have to deduct interest on loan and debentures, because we have seen that interest is tax deductible. So deduct interest. Existing interest is 3,40,000 for both, and the fresh interest is 3,60,000, because in alternative 2 there is no loan or debenture, so there is no interest. But in alternative 1 there is 20 lakhs debt at 18%, so interest will be there. So total interest comes out to 7 lakh and 3,40,000, right? Yeah, now calculate earning before tax by deducting A minus B. You get earning before tax, EBT. That is 15 lakh minus 7 lakh and 15 lakh minus 3,40,000, right? As soon as you get EBT, deduct income tax from it, you get EAT, earning after tax. Okay, so C minus D, that is 8 lakhs minus 4 lakhs. Now how 4 lakh came? It is 50% of EBT. So 50% of 8 lakhs, 50% of 11 lakhs, 60,000 is your tax. Deducted, you get EAT, earning after tax. Now divide that by number of equity shares. Number of equity shares I'm saying, huh? So existing plus new number of equity shares for alternative 1 is 70,000 and for alternative 2 it is 90,000. Existing, there is already 50,000 number of shares, and new it is 20,000 for alternative 1 and 40,000 for alternative 2. So this comes of 70 and 90,000 number of shares for 1 and 2 respectively. Divided by it by EAT, that is E divided by F. You get EPS, earning per share, because now this EAT is total earning for equity shareholders. You divide it by number of equity shares, you get earning per share for a particular shareholder. So for alternative 1 it is 5.71, and alternative 2 it is 6.44. Now looking at these figures, you can give a conclusion, right? That of course alternative 2 is better. As why? Because EPS is higher in case of alternative 2 involving sale of equity shares. So it is advisable to use that source. That's it. So numerical was simple. What you have to do is you have to just calculate the EPS, right? EBIT minus interest gives EBT, minus tax gives EAT, divided by number of equity shares gives EPS. That's it. Okay. Now let's look at another example with few more new points in it. So the second example, right? A company gives you the following figures. The figures are given to you, right? PBIT, that is, it is earning before interest and tax, less interest on debentures, interest on loans. Then PBT is calculated. What you have done, solution is given in a question. Then PBT, P means E, you can alternately use EAT, PBT, whatever. So PBT is 20 lakhs less income tax. PAT, that is EAT, is 10 lakhs divided by number of equity shares. You get number EPS, earning per share. Here you are given current market price and you are given price earning ratio. Let's see what we are asked to do. The company has undistributed reserves and profits of 81 lakhs 50,000. The company needs to raise rupees 36 lakhs for repayment of debentures and modernization of plants. Two alternatives are given to us. One is raising the entire through loan, 16%, and raising partially by sale of 1 lakh equity shares or rupees 18 per share, and the balance through term loan of 16%. So 36 lakhs is required. So in alternative 1, entire 36 lakhs is done by loan, and in alternative 2, 50-50%. 1 lakh into rupees 18, and the remaining one is by this loan. Okay, so it is 18 lakhs, right? So the company expects the rate of return, that is earning before tax and interest on funds employed will improve by 4% because of modernization. That is a new point twist. We'll see what to do about it. And if debt equity ratio exceeds 25%, the P ratio will go down by 6, right? So let's see what to do. Now they are saying it in the last paragraph that EBIT, right? It will improve by 4% because of modernization. That is after. So you have to calculate your EBIT after modernization, right? Then only you can proceed. So now in the solution, you draw a table, right? We'll go one by one. Look at the first row. That is EBIT. Now 34 lakhs. How we have got it? We have got it through working note number 1, because here we are given in the last line that the EBIT will improve by 4% because of modernization. Because of modernization, right? So let's see at working note number 1. So here you have calculated EBIT after modernization. Okay. EBIT percentage on capital employed is expected to increase by 4% after modernization. So we have calculated EBIT like we have to find out capital employed before modernization and capital employed after modernization, right? Why? Because we have to calculate now percentage here, because now we know EBIT before modernization, and if we calculate capital employed before modernization, we can calculate the percentage that how a percentage was EBIT of capital employed and use it same on the after modernization, right? Now, so let's find out capital employed before modernization. Equity capital, 40 lakhs. Reserves and surplus, it was given 81 lakh 50,000. Here it is given, it was given, right? Then 12% debentures and 18% term loan. In the question, we were not given, we were given interest. See, less interest on debentures 2 lakhs, less interest on term loan 2 lakhs. With the help of this, we have calculated what? The 16 lakhs and 12 lakh 50,000, the amount of this debentures and loans. Now, how have we done it? I've shown in working note number 2 for your reference. In the examination, there's no need. If you don't do working note, you can do it directly also. But for your understanding, when you study, therefore I've given it very in detail, right? You are given interest on debentures 12%, 12.5% 2 lakhs. So if you want to calculate debentures, you have to go reverse. So therefore, debentures will be rupees 16 lakhs. That is 2 lakh into 100 divided by 12.5. In the same way, we can calculate the amount of term loan. That is because we are given it is 16% interest is 2 lakh. So with the help of this, we can calculate amount of loan at 12 lakh 50,000 and put up here in working note number 1 in capital employed. So it is capital employed. How much capital will be employed in the before modernization? Additional funds or nothing, right? So your capital employed comes out to be 1 crore 50 lakhs. Now in second after modernization, existing it is there 40 lakhs, 81 lakh, 50,000, whatever. Debentures here we have repaid because we have clearly mentioned that we need additional funds to repay the debentures. So it is repaid here. Term loan is as it is, and additional funds we are requiring 36 lakhs we are given. So here the capital employed after modernization is 1 crore 70 lakhs. Now how to calculate EBIT with the help of this? So just remember before modernization it was 1 crore 50 lakhs. So see what I've done. So EBIT at present we are given is 24 lakhs. We are given in the question. So we have calculated 16%. How can 16%? See in the star I've given down. 1 crore 50 lakhs into I divided by 100 is equal to 24 lakhs. So what is I? 16%. This is how we got that 24 lakhs is 16% of capital employed. And we have said that after modernization, 4% by 4% this is increased. So 16 plus 4% by 20% EBIT is increased. So now what will be EBIT after modernization? It will be 20% of 1 crore 70 lakhs. That is capital employed after modernization. So your EBIT after modernization will be 34 lakhs. This is how you've got your first row, that is 34 lakhs. Understood? I've given all the working notes very clearly. You go through working notes, read it once, twice, thrice, you'll understand. In very simple words I've explained. So now you know how you got 34 lakhs from working note number 1. So now we'll move on with the numerical interest. Deduct interest, that is existing We have taken only loan because debentures are already repaid. Okay. So for plan 1, 2 lakh, and for plan 2, 2 lakh. Fresh interest for plan 1, it is 16% of 36 lakhs, right? Why? Because we are given here raising the entire amount by 16% loan. So it is 36 lakhs by total loan. And in plan 2, it was 50%, right? So in plan 2, it is only 18 lakhs loan. So it's 16% of 18 lakhs rate of interest. This is how you got 5,76,000 and 2,88,000, right? Total up existing and fresh interest, it is 7,76,000 and 4,88,000. Deduct 1 minus 2, that is EBIT minus interest, you get earning before tax, right? Deduct income tax, 50% of EBT, you get EAT, earning after tax. Now this word sounds familiar to you, right? So now as you get EAT, you divide it by number of equity shares, you get EPS. Now in case of plan 1, there is no new equity raised. There's only old equity, that is 4 lakhs given to you in the numerical. Number of shares 4 lakhs. It is clearly given in the question. And for plan 2, it is 5 lakhs. Why? Because 4 lakhs it is old, plus 1 lakh it is new equity raised. So divided, you get EPS 3.28 and 2.912. But here only it doesn't end, because now here you have to give decision on the basis of market price, right? So you have to multiply price earning ratio by EPS. But to decide price earning ratio, you have to go back to the last line of your question. What is that? If debt equity ratio exceeds 25%, P ratio will go down to 6. So here now you have to calculate debt equity ratio for both the plans and find out what is it. If it is more than 25%, it will be 6 times P ratio, and if it is less than 25%, your old P ratio given to you, that is 8 times, will be continued, right? So but here what is the change? Your debt equity ratio formula is given to us. Usually what we know is debt upon equity is ratio, that is only debt above and all equity is below with all reserves and surplus. But here we are given debt divided by debt plus shareholders. We have to do it. We don't have a choice. So we'll have to again divide by debt plus equity here. So let's move on to working note number 3 and working note number 4. I've given a reference also here, right? So let's move on to working note number 3. Now how we have calculated debt equity ratio for plan 1. So debt to equity ratio after raising debt of 30 lakhs. 36 lakhs plus 12 lakh 50,000, because in entire is with loan, right? Entire is debt in plan 1, 36 lakhs plus 12 lakh 50,000 old, divided by, again you have to add both the debts because in the formula it is given to us in the question. 36 plus 12 lakh 50,000, again I've written in the denominator, plus 40 lakhs equity given to us, plus 81 lakh 50,000 reserves and surplus into 100. So you get debt equity ratio as 28.52. Yes, it is more than 25%. And as per given in the example, the PE ratio is reduced to 6 from the present 8 times for plan 1, because debt equity ratio is more than 25%. So now you're clear that in plan 1, you have to take PE ratio as 6. Now let's see for plan 2 in working note number 4. So your PE ratio, how you calculated? Debt to equity ratio for raising debt of 18 lakhs only. Your 50% was equity, 50% was debt, you remember. So 18 lakhs plus 12 lakh 50 old. Again, at denominator, I repeated the same debt because it's given in the question to do it. Plus new equity of 18 lakhs plus old equity plus reserves and surplus 81 lakh 50,000 into 100. So here you get your debt equity ratio for plan 2 as 17.94%. Yes, it is less than 25%. So as per given, we have to continue with our existing PE ratio, that is 8 times for plan 2. Got it? Clear? Move on to our main table, our main solution. So now price earning ratio for plan 1 was 6 times and for plan 2 was 8 times. You know how it calculated. You have seen it yourself in working number 3 and 4 respectively. Multiply 7 into 8, that is EPS into PE ratio, you get market price per share. So for plan 1, market price per share is 19.68. And for plan 2, it is 23.296. Yes, you have to give a decision. And you know that what decision you have to give. Of course, plan 2 involving combination of equity and term loan is better than plan 1, as it maximizes market price of equity shares, right? That's all. That ends our presentation. Thank you so much. I hope you understood. And wait for my more videos in the future. Thank you.